Imagine a small Southeast Asian nation navigating a turbulent global economy with resilience, but facing hidden risks that could tip the scales. Welcome to the latest insights from the IMF on Laos' economic journey. If you're curious about how countries like Lao People's Democratic Republic are steering through challenges like inflation and debt, stick around as we unpack this report in a way that's straightforward and engaging. These end-of-mission announcements from the IMF feature initial observations from expert teams after on-site visits to various nations. Keep in mind that the opinions shared here come solely from the IMF staff involved and might not align with the official stance of the IMF's executive board. Drawing from these early assessments, the team will craft a detailed report for review by management, which could then head to the executive board for deeper analysis and final calls. From Washington, D.C., comes word that an IMF delegation, headed by Angana Banerji, wrapped up talks on Lao PDR's economic landscape as part of the 2025 Article IV Consultation, a routine checkup where the IMF helps countries evaluate their economic policies and prospects, much like a financial health exam for a nation. This happened between November 5 and 19, 2025. Wrapping things up, Banerji shared this key update. Positive shifts in the global environment, combined with smart and decisive policy moves by the government, have helped Lao People's Democratic Republic achieve steady macroeconomic conditions, a balanced exchange rate, and a swift slowdown in inflation rates. We're forecasting solid economic growth holding at around 4.5% for both 2025 and 2026, fueled by booming exports, a rebound in tourism, fresh foreign direct investment, FDI, think companies from abroad setting up shop to create jobs and boost the economy, and a more generous fiscal approach planned for 2026. But here's where it gets a bit tricky. Overall inflation is likely to creep up slowly next year, thanks to that intended government spending boost and hikes in electricity prices, which could squeeze household budgets if not managed carefully. The surplus in the current account, essentially, how much more the country earns from exports and other inflows versus what it spends on imports and outflows, is set to shrink from its high point this year, but overall external finances should stay on even keel, propped up by consistent FDI coming in. That said, some deep-seated issues linger, like skimpy international reserves, the nation's stockpile of foreign currency for emergencies, and hefty public and private debts owed abroad. These call for ongoing work to toughen up the economy against shocks, perhaps by building up those reserves or diversifying income sources. Looking ahead, the risks lean toward the negative in the short run, coming from both worldwide drama, like rising geopolitical conflicts that disrupt trade, and homegrown worries, such as swings in commodity prices, jittery global financial markets, jumping the gun on loosening policies too soon, or even devastating natural disasters that hit agriculture or infrastructure hard. And this is the part most people miss: the banking sector's soft spots, with thin profits and weak capital reserves in major areas, make it prone to getting hammered by unexpected blows. On the brighter side, if regional cooperation, say, through ASEAN initiatives, rolls out smoothly, it could supercharge growth and improve trade balances over the medium term, opening doors to new markets and partnerships. The conversations zeroed in on strategies to back the government's push for stronger growth, especially amid soaring global unknowns, tight domestic resources and skills gaps, slim safety nets, heavy reliance on imports for essentials, and big-time sensitivity to outside disruptions. For beginners, think of it as plotting a course through stormy seas with limited fuel and a leaky boat. You need careful planning to avoid capsizing. On the monetary front, it's wise to keep policy steady but ready to tighten if needed, since money conditions are still pretty loose and inflation threats haven't vanished. As prices are expected to tick up, sticking with the current policy rate, while pushing forward with better ways to control liquidity, like managing how much money banks have to lend, would effectively hike real interest rates and keep the economy from overheating. Letting the exchange rate flex as a buffer against jolts, all while stocking up reserves whenever possible, would build tougher defenses, particularly with the heavy foreign debt load, dependence on imports, and exposure to global ups and downs. To make real headway, accelerating efforts to spread out export goods and destinations, beyond just raw materials to value-added products, and ramp up tourism via improved transport links and simpler visa rules could pay off big. For instance, imagine easier access for eco-tourists flocking to Laos' stunning landscapes. Plus, getting a firmer grip on external and debt data, including debts from state-owned enterprises, those government-run companies, is crucial for smart handling of foreign exchange and borrowing. The proposed 2026 national budget points to a significant loosening of fiscal policy, driven by raises in public sector pay and bigger investments in capital projects like roads and schools. A gentler easing, backed by solid steps to amp up revenue gathering, without overburdening citizens, would free up room for must-have spending on social services and key infrastructure. Revenues have been holding strong so far, but more targeted tweaks are in order, such as beefing up the office that audits big taxpayers, closing loopholes in corporate taxes, setting clear rules for tax breaks to attract investors fairly, and even taxing new industries like digital services or green energy. Boldly put, some might argue this fiscal expansion risks fueling inflation in a debt-heavy economy. Do you think it's a necessary gamble for growth, or a recipe for trouble? Ongoing advances in managing debt, being open about selling public assets, and sharpening public finance controls, including a revamped setup for public-private partnerships, where government teams up with businesses for projects, are non-negotiable. Protecting the financial system's health means keeping a sharp eye on how liquid and solvent banks and institutions are, using reliable data and scenario testing tools to spot weaknesses early. Pushing ahead with tougher oversight, bolstering bank capital and cash reserves, and refining safety rules will shore up the sector's ability to weather storms. Improving the financial health of state-owned enterprises through better management will also dial down lending risks gradually. To unlock higher growth in the longer haul, Lao People's Democratic Republic should tackle root problems in areas like governance, how decisions are made transparently, human development, education and health to build skilled workers, and the ease of doing business, cutting red tape for entrepreneurs. Boosting openness, better teamwork across government bodies, higher quality data, and easier public access to info would ramp up responsibility and smarter policymaking. Keep grinding on modernizing rules, simplifying them, and fortifying anti-corruption measures to spark higher productivity. After all, who wouldn't want a fairer playground for innovation? And here's a controversial angle. While SOE reforms are pushed as essential, critics say they could lead to privatization pitfalls if not handled with care, potentially widening inequality. Deepening changes in state-owned enterprises via efficiency gains, stricter monitoring, fuller reporting, and updated regulations is key to currying fiscal dangers. During the visit, the IMF group chatted with folks from the Bank of the Lao People's Democratic Republic, various government departments, other state bodies, private business leaders, and folks from international aid groups. The team extends heartfelt thanks to everyone for the fruitful exchanges and their outstanding warmth and welcome. What do you make of these recommendations for Lao People's Democratic Republic? Do the upside potentials from regional ties outweigh the downside risks, or is the debt burden too precarious? Drop your thoughts in the comments. Let's discuss how this could shape the future for this vibrant nation.